Hello, everyone. Welcome to the market opening bell on Friday, June 20. Markets are focused on the Middle East situation, with foreign media citing sources that U.S. senior officials are preparing for a possible attack on Iran in the coming days, potentially as early as this weekend. Additionally, news that Guangxi will suspend its trade-in subsidy program for consumer goods after June 20 has put selling pressure on Hong Kong stocks. The Hang Seng Index opened 90 points lower, narrowing its initial loss to 57 points and briefly reaching 23,653 before turning downward. In the afternoon, it fell as much as 525 points to a low of 23,185, closing down 472 points or 2% at 23,237, marking three consecutive days of declines. Cumulative drop of 823 points or 3.4%. The H-share index fell 183 points or 2.1% to 8,410, and the Hang Seng Tech Index dropped 126 points or 2.4% to 5,088. Total market turnover was 220 billion Hong Kong dollars. Southbound funds recorded a net inflow of 1.427 billion Hong Kong dollars into Hong Kong stocks, with net purchases Xiaomi 495 million, China Construction Bank 370 million, Zhong'an Online 278 million, United Energy Group 104 million. Net sales Tencent 1.309 billion Hong Kong dollars, PopMart 835 million, Alibaba 205 million, CSPC Pharmaceutical 147 million, Meituan 117 million. Statistics show southbound funds have sold Tencent for 15 consecutive days, totaling 17.351 billion Hong Kong dollars, while buying China Construction Bank for 7 consecutive days, totaling 4.319 billion. Technically, after the Hang Seng Index fell below its 20-day moving average, it nearly fully filled the upside gap from June 3rd between 23,163 and 23,281. The next support level is 23,000, and if breached, it may test the 50-day moving average at 22,800. Resistance is at 23,500. Shanghai and Shenzhen markets opened lower and continued to decline. The Shanghai Composite Index closed at 3,362, down 26 points or 0.8%, while the Shenzhen Component Index fell 123 points or 1.2% to 10,051. Combined turnover for the two markets was 1.2505 trillion yuan, up 59.5 billion yuan from the previous day. The renminbi central parity rate was set at 7.1729 to $1, the highest since March 19th, up 32 pips from the previous day. Regarding Guangxi's suspension of the trade-in subsidy program after June 20, the Guangxi Commerce Department stated that the program will continue throughout the year, with the specific resumption date subject to official announcements. State media also noted that national subsidies will continue. According to relevant ministries, two batches of central funds totaling 162 billion yuan were allocated in January and April to support trade-in programs in the first and second quarters. An additional 138 billion yuan in central funds will be distributed in an orderly manner in the third and fourth quarters. Back to Hong Kong, Deloitte China's Capital Market Services Department released its IPO market outlook, stating that in the first half of this year, Hong Kong saw 40 IPOs raising 102.1 billion Hong Kong dollars compared to 30 IPOs raising 13.2 billion dollars in the same period last year, a 33% increase in listings and a 673% surge in funds raised. If the current favorable market conditions persist, Deloitte expects Hong Kong to raise more funds in 2025 than previously forecast, with A plus H listing being a key driver. Deloitte maintains its prediction of 80 IPOs for the year, but has raised its fundraising estimate by 33 to 54% from 130 to 150 billion Hong Kong dollars to 200 billion Hong Kong dollars, driven by higher main board PE ratios boosting IPO valuations. Looking ahead, over 170 listing applications are being processed, including more than 5 companies, each potentially raising at least $1 billion US. Hong Kong EX fell $14.2 or 3.5% yesterday, closing at $389.8. Yesterday, we mentioned JD.com entering the tourism sector. JD and Meituan fell 3.6% and 3.8% respectively, while Trip.com and Tongcheng dropped 4% and 10.6% respectively. Airline stocks were also pressured by Middle East tensions, with Air China, China Southern Airlines, and China Eastern Airlines falling 4.7% to 5.5%. Sasa International announced its full-year results for the year ending March 31st. Revenue was 3.942 billion Hong Kong dollars, down 9.7% year-on-year. Net profit was 76.97 million Hong Kong dollars, down 64.8%, with earnings per share at 2.5 cents. A final dividend of 1.7 cents was declared, compared to 5 cents last year. Total annual dividends were 2.45 cents per share, down over 50% from 5 cents last year, with a payout ratio equivalent to about 70% of core profit. The current dividend yield halved from over 8% to 4%. For the first quarter of the 2025-26 financial year, April 1st to June 15th, 2025, total revenue was 811.2 million Hong Kong dollars, up 4.5% year-on-year. Revenue in Hong Kong and Macau rose 9.5% to 624.9 million Hong Kong dollars. Mainland China fell 23.3% to $96.4 million, and Southeast Asia grew 12.5% to $87.9 million. The group plans to close its remaining 18 offline stores in Mainland China in an orderly manner, with 9 already closed by May 31st, 2025, and the rest expected to close by June 30. Our stock pick today is Auntea Jenny, stock code 2589. Auntea Jenny operates China's fourth largest freshly made tea beverage chain, covering all 4 municipalities, over 300 cities across 5 autonomous regions and 22 provinces. Its store network spans from Mohe in Heilongjiang in the north to Sanya in Hainan in the south, making it the mid-priced freshly made tea brand with the widest coverage in China. It has a significant presence in low-tier markets, with the majority of its revenue derived from franchising. As of December 31st, 2024, the group operated 9,176 stores, achieving a GMV of 10.736 billion yuan. In addition to the Auntea Jenny brand, the group has expanded its product range to other freshly made beverages and freshly ground coffee through its Jenny X Coffee and Version Light brands. The group strategically focuses on lower-tier markets, where the freshly made tea market in China's 30 cities and below is the largest and fastest-growing segment by GMV from 2023 to 2028, offering substantial future growth potential. However, intensified competition arises as industry players vie for under-penetrated markets. The group's average per-store GMV declined from 1.6 million yuan in 2023 to 1.4 million yuan in 2024, and the average GMV per order dropped from 26 yuan to 25 yuan. Despite this, the total GMV of the store network grew from 9.7 billion yuan in 2023 to 10.7 billion yuan in 2024, maintaining relatively stable revenue, primarily due to the expansion of its store network from 7,789 stores as of December 31st, 2023 to 9,176 stores as of December 31st, 2024. Gross margin improved from 30.4% in 2023 to 31.3% in 2024, driven by ongoing cost control. Since March 2024, the group has promoted Force T and upgraded version Lite 2.0 brand concept to franchisees, featuring distinctive branding, enhanced store designs, and new promotional campaigns to further capture demand in lower-tier markets. As of December 31st, 2024, Force T reached 304 stores within 9 months of its launch, generating a GMV of 73.8 million yuan in 2024. Additionally, the group has actively explored new sales channels, with online sales surging from 4.8 million yuan in 2023 to 64 million yuan in 2024. Looking ahead, with China's economy and consumer market both expected to grow alongside the expanding scale of the freshly made tea and coffee markets, the group is well positioned to capture future industry growth. Recommended buy price 135 Hong Kong dollars, target price $148, stop loss $128. I do not hold the aforementioned stock.